So hello and welcome to the first webinar of the 2021-2022 Financial History Webinar Series. We have a full program and we are very, very pleased to welcome today Bill Kelson. Bill Kelson is a Ph.D. candidate at the University of Georgia with interests in Chinese history, financial history, and the history of capitalism and colonialism in East Asia. He's currently in London on a graduate school award conducting research for his dissertation titled Shanghai Panic, China's First Big Debt Crisis. In the spring, he will be at Academia Sinica in Taipei on a Fulbright-Hays fellowship. So for those of you who are first here joining us, Bill will have 30 minutes to present his paper, and then we're going to open the floor for questions. You can ask your questions via the chat or via using the raise your hand tool. So thank you so much, Bill, for joining us today. It's going to be a pleasure to listen to your talk, and the floor is yours.
Oh, thank you so much, Paula. It's a real pleasure to be here. This is actually, as I was telling them before, my first kind of experience putting this project under the sunlight here in front of a wider audience. So it's nice to start here at the Financial History Network. For the sake of trying to stick to time, I'll take maybe 10 minutes up front here to talk about some of the core ideas of the dissertation, which, as Paula said, is tentatively titled Shanghai Panic, China's First Big Debt Crisis. Then I thought I'd take 10 minutes or so to talk through some of the more technical financial aspects of the study in a bit greater detail than they appear in the introduction, which some of you will have read through the mailing list. Then hopefully I'll have a little time at the end to talk about the use of qualitative evidence in the project, since I know that's a topic of interest here at the Financial History Network. As my title suggests, the main argument I make in the study is that the financial panic of 1883 in Qing China was really China's first ever great empire-wide financial crisis, at least in the sense of a kind of deflationary depression caused by the bursting of an asset price bubble, or in reality, multiple asset price bubbles across many sectors of the late Qing dynasty economy. So these included some of the classic ones you'll know, real estate, as well as China's very first stock market, but also most articles of international and interregional trade. Where prior studies of the panic, which are surprisingly few actually, have tended to frame the crisis as one confined to China's then sort of nascent financial center at Shanghai. My work shows that the bursting of these many bubbles was actually felt throughout the Qing Empire. Another way to put this is to say that what followed the crash was a dynasty-wide depression that lasted into 1885 and whose longer-term effects hung over China for many years afterwards. Methodologically, I slowly came to this new interpretation about the scale and scope of the Panic of 1883, in part by comparing evidence I was reading in Chinese and English to debates within the economics literature on financial crises. So the panic has yet to be understood in the historical literature as a depression on the scale it actually occurred, but I think all the familiar signs are there. So you had a series of abnormal asset price inflations during the boom period, with firms and individuals, some quite famous, levering up using credit, especially in real estate and stocks, sometimes using both as collateral for further lending, followed by a genuinely massive deflationary spiral that included financial contagion spreading far and wide. There was also genuinely serious fiscal disruption at the height of the crisis, which checks out with what we know about the kind of normative experience of deflationary depressions elsewhere and at other times in history. Other telltale signs here include waves of bank runs, waves of defaults, market seize-ups, downward price spirals, all indicators that would be familiar to those of you who've spent time kind of digging into the literature on deflationary debt crises. I should say here that I'm not a trained economist, but a historian who's drawing on literature in finance and economics. So if there are those of you here with finance or econ backgrounds, I'd love to hear your thoughts and recommendations for integrating findings from those fields into historical research. It's something I think a lot about, and I have personally found some of the more historicized models of financial crises to be the most helpful to me, certainly more than the more rigidly formal models, excuse me. But I'm open to suggestions, especially since I've really just begun to draft some of the later chapters of the dissertation. Okay, before I jump into what's maybe more interesting, which is the financial instruments and institutions that are at play in my story, there are a couple of more sort of key arguments I need to flag, both of which are downstream of this idea that 1883 was China's first big debt crisis. And both of these relates to the historiography on the wider late Qing period in Chinese history, which is from the Opium Wars, roughly 1842 to 1911. So this era in Chinese history is often framed as an era of more or less inexorable decline for the Qing dynasty, both economically and politically, a framing that I think is sort of broadly true, but needs a great deal more nuance, especially from the economic and financial perspective. My first argument against this kind of monolithic declinism narrative relates to trade, both international and interregional. One thing that emerges in my study from an understanding of the sort of sub-period between 1864 to 1883 as a credit-driven trade boom before a crash is a new understanding of the impacts of trade liberalization on China's economy in the 19th century. So the most important conclusion here is that the semi-colonial treaty port system that emerged in China after the Opium Wars and the Taipei Civil War of the 1850s and 60s. And in this system, Chinese ports were forcibly opened to much greater volumes of foreign steamer trade under unequal treaties signed with foreign powers. This process actually had some stimulative effects on China's economy, at least in the medium term, separate and apart from how politically defensible the treaties were, which of course they were not. Trade liberalization could be, and sometimes was, broadly beneficial, just as it could create dependency, just as much as it could create sort of more familiar dependency relations between core and periphery, especially in, and this was especially true in China's more commercialized areas, where peasant families grew crops and produced handicrafts for local, regional, interregional, and then increasingly international markets. If you read through the sort of local and commodities literatures on trade in this period, you'll find discrete booms. So you'll see sugar booms in Guangdong, or cotton booms in central China, tea booms in Fujian and Taiwan, silk booms up and down the Yangtze River. But these kind of discrete regional and commodity stories have yet to be connected as a wider experience of a boom that depended on trade finance at Shanghai, which is a major contribution of my study. As far as the data on this go, the statistics we do have, both on sort of peasant farm incomes in silk and tea regions, and on wage growth in port cities, are commensurate with the idea that there was a generalized trade boom up until 1883. Both wages and farm incomes appear to have grown quite substantially in the 1870s and early 1880s, before leveling off again in the later 1880s and 1890s. So I would argue that it's really only after 1883 that China's economy begins to look more archetypally colonial, characterized by staple export dependency at declining world prices, and with demographics eating more seriously into productivity gains. Okay, so that's the first way in which the study challenges the more rigid of the declinism narratives. The second has to do with industry, and in particular China's failure to keep up with both the West and with Japan as an industrial power to 1911, when the Qing dynasty fell. So my argument here is quite multifaceted, and I don't really have time for a full airing, but suffice it to say that it involves China's first stock market. So the stocks that were traded there, which were bought and sold by Chinese merchants and bankers who'd made some pretty serious fortunes in the boom, were issued by these sort of sui generis, semi-public, semi-private firms affiliated with the Qing state. So these were steamship and mining firms meant to be first steps on a Meiji Japan style road to industrialization, often called in English the self-strengthening movement. In prior scholarship, these self-strengthening firms were either ignored or they were downplayed as quixotic ventures. But in my view, they were really quite successful down to 1883, and it's the crisis that marks the beginning of their decline. Kind of like my argument about trade, you see in the secondary literature on the individual companies that the crisis is this watershed, but it's less well understood in the general historiography on China. So when the stock market collapsed completely, Chinese merchants ultimately shunned these self-strengthening stocks and gravitated instead towards the more seemingly stable securities bought and sold on Shanghai's separate foreign stock market. This was obviously disastrous for economic self-strengthening as a political project. So in that sense, I think the 1883 crisis is better understood as a historic fork in the road for the divergent paths taken by China and Japan in the 20th century. Okay, so that's a big argument. That's the 10,000-foot view. But what's perhaps of more interest to the group gathered on this call, which looks quite large, I'm very encouraged. What might be of more interest here is the role of finance. More so than perhaps other historians of the 1883 panic so far, I think it's really important to stress the institutional structure of the late Qing financial system, since this was in many ways what determined the nature of the crisis. In late Qing China, at least before 1883, there were by and large 3 types of financial institutions. So you had local banks, or qianzhuang, interregional remittance banks, or piaohao. Then there were what were at the time called Indian exchange banks, which is to say British colonial banks with substantial exchange business across both East and Southeast Asia, and South Asia as well. The most famous of these, of course, was HSBC, which, while founded in the 1860s, was by the 1880s already one of the largest financial institutions in the world. Both types of Chinese banks were not joint stock banks, of course, but unlimited liability partnerships, largely responsible for various types of trade finance. As for the local banks, or qianzhuang, their main functions were to handle copper-silver exchanges, copper and silver being China's 2 main currency standards, and to issue short maturity promissory notes, or bank drafts, called zhuangpiao. And these were used in retail trade and could sometimes function as local currency substitutes. These are actually quite beautiful notes if you've seen them, and they have calligraphy sometimes in the margin. These zhuangpiao were negotiable instruments issued at a discount to merchants on good credit and formally guaranteed by the bank of issue. The notes after issue could be used as means of payment and were later cashed with that same bank of issue by the recipient of the note, typically in a trade transaction. So that could be a foreign merchant, could be a Chinese bank, could be a foreign bank, whatever. The urban banks in China in this period also redeemed the notes of other banks sometimes, and then cleared these at daily meetings of especially Shanghai's 2 banking guilds. According to or sort of in these guild meetings, you had interbank discount rates set on these notes, which had some ramifications for the wider money market, which I'll talk about here in a minute. Okay, so that's the qianzhuang. That's one institution. The second were the remittance banks, and their function was to issue long-distance bills of exchange, or yinpiao, to wholesale merchants. These silver notes, unlike European-style 3-party notes, operated more like silver bank drafts that could be purchased for a flat fee up front, rather than post facto discounted. And they could be cashed at any piaohao. And these banks had pretty widespread national networks across Qing cities that greatly expanded during the boom years. And in fact, one reason that the scholarship on these institutions, I think, has not completely missed, but somewhat missed their key role in the Panic of 1883 is that scholars have rightly been quite interested in how these banks successfully dealt with the principal agent problem in an early modern setting. And there's increasingly just very excellent work on these Shanxi piaohao banks. So both types of banks, as I suggested, rapidly expanded during the boom in terms of their size, in terms of their number, and in terms of the reach of their note circulation. Then after the Opium Wars came the foreign colonial banks, above all HSBC, but also a handful of other crown-chartered joint stock banks. So their business was mostly in international exchange and trade settlements and remittances, but they also, unlike the older style Chinese banks, made direct loans for commerce and industry. They extended overdrafts to their wealthiest clients and sort of more generally operated like banks that we would be familiar with today. As I argue in the dissertation, these 3 institutions, 2 Chinese and 1 foreign, evolved during the boom into something approaching a Sino-foreign financial system, not just sort of 3 distinct institutions offering separate services side by side. And it's this financial integration across China that goes a long way in explaining why financial contagion reached as far as it did in 1883, since the piaohao had a national network and the qianzhuang increasingly kept correspondence with other banks in further and further flung provinces, and also began to issue longer distance bills of exchange themselves. All of that said, the most crucial phenomenon that made the Chinese system in this period, in my view, an ad hoc system, was the emergence of interbank lending between these 3 institutions. So the interbank lending at the heart of my project both undergirded boom era growth and fueled the asset price bubbles I referred to earlier, which led to the 1883 crisis. So let me break that down a little bit. The most familiar instrument of interbank lending was the Sino-foreign chop loan, or piaohao, issued by foreign banks to Chinese local banks, especially, although not only, in Shanghai. So these chop loans were invented at HSBC by one of the bank's Chinese intermediaries or compradors in 1869. Could call it financial innovation, if you like. And they were invented as a way for foreign banks to earn a bit of extra interest and for Chinese banks to supplement their relatively small bases of working capital. Chop loans typically carried 2 to 10-day maturities and a hefty 12 to 28% interest rate, at least on an annualized basis. Of course, that's why they were attractive to the colonial banks. Chinese banks got more capital than they sort of couldn't get elsewhere, which they in turn lent on equally short maturities to merchants. And the colonial banks got their high interest. But of course, high interest also meant high risk. And the Chinese banks ultimately came to depend on turnover of chop loans to stay afloat. The security that was posted for these chop loans was often no more than a bank promissory note, or chop in the language of the day, meaning that these were essentially quasi-unsecured loans. The foreign banks did sometimes require a guarantor contract from a third party, but the customary practice of bankruptcy in Qing China was quite different than Western practice. In the event of a non-payment of one of these chop loans, a Chinese guarantor, who was typically a wealthy merchant himself, pledged only to look into the matter and not to actually repay the borrower's debts. So there's no fiduciary responsibility that came along with signing a guarantor contract. And this was something that the foreigners really didn't understand about Chinese bankruptcy in the legal system until 1883, when they became quite familiar with it, and quite fast. And in fact, these guarantor contracts became probably the major flashpoint of the financial crisis. And they're one of the interesting things about my project that hasn't really been drawn out of the literature before. So those were chop loans. The other interbank instrument was the so-called long-term loan, or qianzhuang, which was a loan from the larger Chinese remittance banks, or piaohao, to the Chinese local banks. And these are quite understudied, but also very important as a form of Chinese to Chinese lending that was going on in these years. So the long-term loans were called long-term. It's a little bit of a misnomer because they were essentially call loans that didn't have fixed maturities, which is to say that the piaohao could call them at any time, and sometimes they did. Local Chinese banks, especially at Shanghai, combined chop loan capital with the capital from these long-term loans to greatly expand their operations during the boom years from 1864 to 1883. But when the music finally stops, which is to say when discount rates reached an all-time high, just as trade was also slowing, the remittance banks called all of their long-term loans at once. The foreign-based banks ceased issuing new chop loans, and all of this left the qianzhuang, or local banks, in trouble, beset by bank runs, bankruptcies, mass closures, and all of this supercharged a deflationary pressure across markets in China. Okay, so that in a nutshell is the very schematic view of my story in the dissertation. And it's why I framed the crisis as largely endogenous to the financial system, to use the jargon. I guess you could quibble and say that foreign bank capital infusions were technically external or exogenous, coming from outside. But I think if you see them as being part of an ad hoc financial system that were used sort of concurrently with this long-term, so-called long-term loans from the piaohao, it's really a crisis internal to the dynamics of the financial system. You can even see this in the way that some of the like when the crisis hits, the language that is used in some of the papers and writings is qianzhuang, which effectively translates to being squeezed from both ends equally between the foreign banks and the larger Chinese remittance banks. Okay, so those were the main drivers of bank leverage during the boom and then later of deleveraging. But financialization and speculation could take a variety of forms. So on the Chinese side, you get the increasing use of banknotes in place of hard currency in interior purchases of particularly tea and silk, but also other commodities. And then you also get the replacement of cumbersome bullion shipments in tax remittances to Beijing, as well as to other provinces in China, these interprovincial remittances. So all of these sort of classical bullion shipments that were the purview of the Board of Revenue get replaced in favor of piaohao bills of exchange to remit all of the government's funds. When the sort of main bank responsible for this remittance business collapses in 1883, that transforms what is a private sector financial crisis into a fiscal crisis. The government couldn't get their remittances, and any actual silver available for remitting funds isn't available because everyone's hoarding. There's widespread cash hoarding going on, which is still another sign that this was a kind of classical deflationary depression, that being sort of another sign. On the foreign side, where leverage was concerned, the new joint stock banks like HSBC increasingly replaced agency house, kind of in-house merchant financing. And for those of you who saw Dan Du's talk here at the Financial History Network, that's what I'm referring to, this kind of in-house financing. That's replaced by the bank financing for a lot of smaller foreign merchants who increasingly use overdraft accounts to engage in speculation during the boom. So a lot of these private merchants and brokers could get overdrafts, which they would use to make speculative purchases and sales of metals or opium or kerosene, all of the kind of major trade goods of the boom period. And in fact, the most infamous foreign bankrupt of 1883 was a Baghdadi Jewish resident of Shanghai named Benjamin David Benjamin, who kind of followed this roadmap during the boom years. He kept lockboxes at every foreign bank in Shanghai, where he would place his foreign stocks or real estate deeds in Shanghai and use them as collateral for speculative trades. But he would often reuse them in other trades at multiple banks. So he's pledging the same collateral all over the city, which made the legal proceedings around his eventual failure extremely thorny, and selfishly, I should say, quite useful as a window into the crisis. It's important to note too that the use of stocks and real estate as collateral in this way was not just confined to Shanghai's foreign community. Chinese merchants used both Chinese stocks and urban real estate holdings to lever up, some to degrees that Hyman Minsky, for instance, might have called Ponzi lending, in which the slightest dip in prices and therefore profits made their operations extremely financially fragile. So this, for instance, was the experience of the Chinese merchant banker of Xu Run, who was one of the few Chinese bankrupts from the crisis for whom we have genuinely good historical information, at least on a kind of individual basis. All right, to step back a bit then, the Qing system was not a financial system in the sense that we think of financial systems today, with a central bank overseeing joint stock banks or other more complex institutions and instruments. But it clearly had the capacity, I think, to create or generate credit risk, which is to say of borrowers like Xu or Benjamin defaulting, as well as liquidity risk of Chinese banks defaulting. And then in 1883, both of these happen all together and en masse. Another way to put that point is to say that this was the first real instance of systemic risk in the banking sector across the Qing Empire, where in prior years, Chinese banks rarely had financial interests outside of particular cities or provinces, and were by and large a bit more stable, I would say. Their only real risks being bank robberies, for one, or exchange risk from fluctuations in the price of silver, which a number of scholars have written more about in an earlier period. Okay, so I think there's a little time here to discuss some of the evidentiary issues, especially the balance between using quantitative and qualitative evidence in a study like mine. As far as evidence goes, the first thing I'd say is that if you want quantitative evidence on the crisis, there's not much, but it also doesn't make the project impossible to study. If you were to sort of start a list of the data we don't have on China for this period, that would include annual GDP numbers, it would include annual population statistics, it would include most balance sheets for really any of these Chinese banks. It would also include trade figures for Chinese to Chinese trade, which is to say regional and interregional trade, at least the portion of it, the large portion of it, which was still carried on in sailing junks rather than steamships in the 1860s and 1870s. What we do have are China's external trade figures from the Imperial Maritime Customs Service, And there are also some decent estimates over longer timescales for regional and interregional trade volumes in China. But all we can really do fundamentally is speak about orders of magnitude. So even the foreign banks that were operating in China at the time, as I'm finding here in the archives, kept fairly poor records about their early years. We do thankfully have, for one, interbank discount rates that were set by the two main banking guilds in Shanghai. And these were published in Chinese newspapers beginning in 1872. And these papers were read across China, which in a way is a kind of evidence for the convergence of the national money market around the Shanghai market. The interbank discount rates are really useful. They show the complete fall off during the crisis quite well. And they also kind of give you an idea of what might have been the benchmark for discounts, interest rates, and other fees across China, but they don't really paint a comprehensive quantitative picture of the financial crisis. That wouldn't be sufficient to say much sort of comprehensively about the story here. Okay, so I think this lack of quantitative sources speaks to something I find both interesting and unusual about studying this period in Chinese history between the 1840s and the 1890s. Because on the one hand, it's really essential to understanding China's integration into global capitalism, as measured by the studies we do have on price convergence across commodities, not just silver, which converged with world prices way before this period, whereas other commodities, their prices converged much more seriously in the boom period. So we have those numbers, but the available statistics for the 1840s to 1890s, say, are not even as much as you would get in the 18th century, when much of China's foreign trade, at least with Westerners, was restricted to a single port at Guangzhou or Canton. And the same is kind of true in a different key for the period after 1890, when you really start to see Chinese language journals, trade journals in particular, come online, which publish much better statistics about their particular trades, where the era that I'm studying really just gives you a few general newspapers in both English and Chinese. But also you have a series of newly opened ports for international trade. Okay, so if you add to this the fact that many late-Qing records are scattered from Shanghai to Taipei to London, where I currently am, and it can be difficult to study this time period, despite its genuine importance. I also think this partially explains why the 1883 crisis has been known to financial historians of China, but it hasn't gotten its full due in late Qing historiography. I think too that given the paucity of quantitative sources on China's economy between 1842 and 1883, the Panic of 1883 itself is an extremely useful prism through which we can learn about this period as a whole by relying on qualitative sources. The crisis turned up all kinds of conversations, both public and private, about the 20 years or so that came before, which sort of might not otherwise have appeared in the historical record. Essentially, people just have to describe things that have been going on in private or quietly behind the scenes. These discussions are voluminous enough that they can help us, or me, I guess, sort of reverse engineer a history of the boom, not just the bust. A great example of this are the long-term loans that I mentioned before, for which we don't have really that many banking records, but the Chinese papers talked all about it, at least after 1883, as a way to explain to their readers why all of these banks were failing all around them. If I've got time here, I'll just point out a couple of more examples of this sort of use of qualitative evidence in financial history, and then I'll turn it over to Paula. The first, as I've alluded to briefly, is the naming conventions for the 1883 crisis. In addition to all the various regional names it was given, in Shanghai itself, it wasn't called a depression or a deflationary depression, of course, but it was called the Daobi Fengchao, which is a kind of unusual phrase that means roughly debt default unrest. It's not a phrase that has been used widely before or since, I think, but it's also a perfectly defined descriptor of what a debt crisis looks like on the ground. So unrest, defaults, angry merchants, angry depositors, bank runs, and the like. But if you sort of think about it this way, if you take the commonality of experience across China during the crisis, and then you pair it to the fact that there aren't really unified naming patterns for the crisis. That I think is itself evidence for this both being China's first big debt crisis and for it being the first, not just a big debt crisis, because there's not really a common language or a common experience to point to here. Okay, so that's one, the naming conventions. The other big one for me in my work, as you might have guessed, is legal records. You obviously get a spike in bankruptcies during the crisis, both foreign and Chinese, and these are incredibly useful documents for understanding the whole era. For one, there are the Benjamin cases I mentioned before, of which there are, I think, 8. I thought there were 7, but then I just discovered a new one in the archives. And these are invaluable for understanding overdraft lending in particular at the foreign banks. Likewise, the bankruptcy of Shanghai's largest qianzhuang, or local bank, which was called the Taipei Bank, or Taipei qianzhuang, has been, the records on that have been equally invaluable to me for understanding Chinese banking. So when Taipei goes bust, its depositors and its creditors, which include these Shanxi piaohao or remittance banks, they line up to sue, and you can learn a lot from those lawsuits. We don't, unfortunately, have the Shanghai magistrates' records where the actual lawsuit would have occurred, but we do have the newspaper reports in Chinese on the bankruptcy of Taipei, which are detailed enough. They're not perfect, but they're okay. And that's sort of one of many ways that financial crisis allows me to use legal records to reconstruct a better picture of what the broader late-Qing financial system really looked like. Okay, due to time, I should probably stop here. I would just like for a discussion, the project being a bit more comprehensive than, or wide-ranging than I had originally designed it as. There's a bunch of stuff I didn't get to talk about, including the lender of last resort function, the banking guilds in a little more detail, the role of real estate. I'd also love to hear from the audience if you have experience studying British financial imperialism in other regions, if you have book recommendations or other kind of comparative perspectives that would allow me to think differently or better about the crisis. For that, I am all ears, and I'll turn it over to Paula now.
Thank you so much, Bill, for this great presentation. So we now open the floor for questions. As I mentioned before, you can ask questions on chat, or you can just use the raise your hand function. And I'm very happy to say that we have a couple questions by Jajan Yu. So her questions are, how do you see the influence of the 1883 financial crisis on the development of the Chinese stock market after the crisis? Did it give way to the development of the foreign stock market in Qing?
So not completely. There were later Chinese stocks, but the biggest impact of the collapse of the this particular iteration of the Chinese stock market, which was the first, was that for say 10 years later, really until the 1890s, you don't get that same kind of stock issuance in Shanghai, which deprives the actual self-strengthening companies, mainly mines that are scattered all over China, and the China Merchants Steam Navigation Company, or Jiaoshangju, from capital. So it's not the death knell of Chinese investors investing in those kinds of securities, but it definitely sets China back enough that by the time there's more active interest in Chinese issued securities, the Qing dynasty is done for, and the self-strengthening movement has really gone by the wayside. At least the economic components of the self-strengthening movement, if that's clear.
Great. Thank you, Bill. So Sergio?
Yeah, thank you very much, Bill, for your presentation. It was a very interesting talk. I have, I think, 2 questions. The first one regarding your argument. So in your abstract, it says that your main argument is that China's financial system was not well integrated before the trade boom of the 1860s and 1870s. And I was wondering, to what extent, even if it wasn't well integrated, how developed it was, how mature it was in terms of, and you've mentioned legal records, but I was also wondering regulation at the aggregated level and how well regulated it was, and if this had anything to do with what happened with the crisis. And the second one is you sent us another document with the story of well, the bank robberies or legalized bank robberies of Fusu, which I found very, very interesting as well. And then there you mentioned, I was thinking of in terms of sources with this part of your dissertation, you mentioned that you're extracting information from the missionaries. I don't know if there are parishes or documents or archives of these parishes that you can use also to elaborate just as primary sources for your arguments of what was happening in this moment, as you do with what was happening in Fusu and with these runs and robberies that you mentioned in that document.
Yeah, first of all, that's good advice. And if there are those of you on the call who have used those missionary records for China or other places to study finance, let me know. The answer to them is kind of the same, actually. The part of the point of that little, I don't know if the thing that I sent around is going to end up being the preface to the dissertation, or if it's going to be a kind of inter-chapter interlude. But the point of it is that even in Fuzhou, which was the city in China circa, say, 1850, that had the most widespread use of local banknotes, the circulation of those banknotes tended to not exceed the provincial boundaries. The biggest of the banks in a city like Fuzhou in southern coastal China would issue banknotes that could circulate within the province, but you almost never saw them anywhere else. And a bank in the north, say, wouldn't redeem a banknote from a bank in Fuzhou if they saw it. But that's what begins to change in the 1860s and 1870s, is that you get these large Shanghai banks, not just the Shanxi piaohao or the remittance banks, but very, very large banks with trading interests, largely up and down the Yangtze River region, but not just. You have banks that have interests in Beijing and Tianjin and other cities in the north. As far as risk is concerned, there was always exchange risk for as long as China was on the silver standard and importing silver from Latin America and Japan. There was exchange risk from trade in silver and related to overseas trade. But that's different in my argument than banking, like within the banking sector level risk that could create a bankruptcy crisis of the scale that I'm alluding to. So Lin Manhong has written, and Austin Dean to a degree has written really great books on the silver crisis in China, in which every provincial government ran into tax payment issues related to the exchange rate between copper and silver, when you had spikes or dips in the price of silver, which was pretty globally integrated with China. What you get in my period is something quite different, where a bank crisis in Shanghai could create bankruptcies in every major Chinese commercial city. And then those would be felt across the countryside, because a lot of those provincial cities were doing secondary financing for their tea or silk or cotton or other trade good districts. So this exposed peasants who were commercialized and growing for the market to this kind of systemic financial risk.
Thanks, Bill. So while we wait our colleagues to pose more questions, I have one question. It's more like a two-part question. So since at the beginning of your presentation, you mentioned that you're willing to converse with different analytical models, I was thinking how the story you're trying to tell us actually relates to the analytical framework that William Quinn and John Turner developed in their book, Boom and Bust. So basically what they do is to compare bubbles with fires. So they call this the bubble triangle framework, in which they identify three major components to this fire, this bubble: marketability, money credit, and speculation. And they also identify two kinds of sparks, so technological innovation and government policy. So my first question is, How do you see these two kinds of sparks relative to the story you are tracing? And the other part of the question is, they also argue that this crisis, the moment's bubbles bust, the opportunities for renewal or creative innovation. What are the kinds of creative innovation that you see after the crisis? And are they mostly local, regional? Are they co-opted by private actors, by government policy? So I just wanted to hear your thoughts on this.
That's an interesting framework. I would say first that I don't think as a spark, I don't think government action really has much to do with this particular crisis. I should cycle back and answer the earlier question about government regulation, though, which also plays into my point about this being China's first kind of empire-wide crisis, which is that you only had local bank regulation to the extent that you had regulation of these Chinese banks. They had to register for a permit effectively, but that was really it. There wasn't oversight of these banks. Most of the oversight was done kind of quasi-privately under the purview of banking guilds, which play a role in my story. There's a little more regulation put in Beijing during the boom period, where there are just a bunch more banks, but none of that really has any bearing on the crisis. If anything, it's very unregulated banking in this I wouldn't say early modern context, but changing context. The second trigger you mentioned is technological, and I don't think technology was the trigger for the crisis per se, but I do like Carlota Perez's concept of a boom period being coincident with the implementation of a particular set of new technologies that change finance. And so that's absolutely happening during the boom period. The boom is in part driven by the opening of the Suez Canal, the rise of the steamer trade, even foreign-facing bills of exchange in China. They are increasingly being replaced by telegraphic transfers and other kinds of and even for the bills, the usance of the bill shortens from 6 months to 3 months, which increases financial turnover and China's exposure to financial turnover. So there are a number of in the boom years, there are a number of changes in the financial system that relate to changes in technology, but none of them are specific triggers for the crisis. So in that sense, maybe I don't see those as the only two kinds of sparks. The real spark here was just a kind of macroeconomic decline in the trade boom that exposed a bunch of banks to lower profits, such that they were so highly leveraged that they couldn't continue to operate.
So we have a question on chat by Jita Patel. Can you speak a bit more about lenders of last resort and insurance, such as covered in the work of David Moss?
I don't know. David Moss, you said. I don't know David Moss's work, but I will read it. I'm trying to think more about this question of lender of last resort, because China doesn't have a central bank in this period. It has a board of revenue, which mainly handles the remittance of the land tax, among other kinds of taxation in China. But it doesn't have a central bank regulator of any kind. And if anything, as I put it in the introduction that those of you read, the foreign banks, by handling the foreign-facing exchange of China and being just the largest financial institutions in China, period, are kind of like semi-colonial central banks. They're not central banks in that they don't have all the same functions, but they are the only institution that could have, or institutions, plural, that could have played some kind of lender of last resort role during the crisis. And of course they don't, because they're interested in their own bottom lines. So that is in many ways one of the downsides of being a semi-colony or hypo-colony, financially speaking, as some people have called China in this period. So there basically is none, and you see the effects of what happens across the banking system, which is just pure chaos.
Thanks. It's actually David Moss wrote this book a long time ago, and I was part of a kind of insurance network in the 1990s. called When All Else Fails. So it might be interesting, and it's about the US, the early US, which was both central but not, you know, was there were dispersed economies. So, I mean, it would just be worth your looking at.
Yeah. Some of my advisors are Americanists. They study finance, but of the US. So they have written on panics where the New York clearinghouse essentially covers some of the same function. So maybe that's in the Moss book. And some of that is done in the banking guilds during the crisis. Unfortunately, the banking guild records are the one place that I can't access right now because they're in Shanghai, which I can't go to currently.
So that's my second thing was, you know, what did the banking guilds do? Because I figured that would be the closest thing. I mean, basically, if you don't have a kind of central, like in the US, right? I mean, reinsurance often is. I worked with Washington. We were talking, you know, we had conversations with Washington about reinsurance in at times of major crisis, and you know, I wondered if, you know, collectives did that like guilds. So that was the next thing because you're mentioning the guilds was so provocative.
Yeah, that is. I hope someday soon China will reopen so I can take a look at those records. From the fact that there is a regeneration of some of the larger banks, just they come back again or in different forms. My suspicion is that a lot of the bankruptcies were handled in-house by the guilds of the other large banks, to create as much stability in the system as possible. And I know for a fact from peripheral records that they rewrote their rules, but I don't have the full extent to which they rewrote those rules, so I can't say much more specific, unfortunately. But it is fascinating.
Fascinating. Can I throw in another question no one's asking? Could you talk a little bit more about real estate?
Sure. I think a lot of the more recent scholars who have looked at the panic from the Chinese historiography have been interested in the stock market because it has such political ramifications, and they haven't necessarily seen the crisis as a wider series of multiple bubbles in real estate and in trade. So that's one contribution of my study, but the real estate is the one that I think is sort of the least known, actually. And it's a kind of multi-faceted real estate bubble that coincides with the rise of both Shanghai and Hong Kong as major financial centers. So the Hong Kong land mania hits slightly earlier. The bubble burst there in 1882. And it wasn't fully connected with the Shanghai crisis at the time, but a lot of the actors are the same in both places. They have interest in Hong Kong and in Shanghai and in Guangzhou. So they are, in my mind, related parts of the bubble. And the trade boom, Hong Kong has the same dynamics during the trade boom. But what happens in Hong Kong is unusual because the bubble is in part a function of, here's a government trigger in the Hong Kong case, which is to say that the governor of Hong Kong at the time, a man named John Pope Hennessy, who was seen as, in the colonial politics of the day, pro-Chinese, he opens up the capacity to purchase downtown real estate to Chinese, where it had previously been restricted to foreigners only. And so pretty quickly, all of these qianzhuang, or local banks in Hong Kong, begin lending tons of money to Chinese merchants who want to buy up this kind of prime real estate. And then they use those real estate deeds as collateral to buy more. And they're flipping houses all over the place. And that's without the explicit colonial politics. That's the story in Shanghai as well, where technically the foreigners weren't allowed to own land because they were living in concession areas under the treaties, but they effectively owned land by purchasing deeds that their Chinese intermediaries bought for them. But the Chinese intermediaries often then sold and flipped and resold these things many, many times, and tried to develop particularly residential housing in Shanghai. Because it's a boom, the city itself is booming, and there needs to be much more residential housing for Chinese workers, Chinese merchants, everyone. So a lot of Chinese, they get in on this action and get into the real estate flipping business. And this is another area where the court records have come in. There are a couple of cases that I have found, which is often Chinese journalists showing up on the scene and trying to figure out who even owns the property, which there are 3 or 4 layers of property ownership, and they can't even figure it out, and the magistrate can't figure it out. And the losses end up just sort of being distributed by a frustrated magistrate or intermediary who says, you know, I can't figure out who actually owns this darn thing. It's a fascinating subject, and it's one of the parts of the study that's a bit new, and I'm looking forward to writing out a little bit.
Yeah, that's fascinating and such a lesson, you know, I mean, for the 2008-2009 crisis and continued reinvestment in real estate globally, actually. Yeah. Yeah,
and the uptick in real estate goes up as the profits in the other trades decline. So merchants, in my argument, I think they are responding to lower profits in trade and shifting capital into real estate.
Yeah, into what feels like it's, you know, solid. Yeah, sorry.
For sure.
Thank you.
Yeah, no U.S. treasuries for them to buy.
Yeah, exactly.
Great. So we have 2 more questions. Perhaps we can collect those questions together. Sergio and Mary Bridges.
Yeah, thank you. I'll try to be super brief as I already went. But I was wondering, and I think this builds on Gita's question of access to resources. So in terms of not there being a lender of last resort, but did they have access to any other money markets, in the sense that you're already mentioning, well, foreign and internal banks and trade? And was there any room for speculation, or were there any interests? I'm thinking in terms of the Big Short, where was anyone winning with this debt crisis?
Sorry, say the last question again. I think
was there anyone winning with this debt crisis? So you mentioned, well,
I see.
the losses, but on the other hand, who was winning, and if there was, like, I don't know, collusion or speculation or these kinds of things.
So before you answer, Bill, can we just take Mary Bridges' question?
Sure.
Hi, Bill. Thanks very much for the paper. My question's a little on a kind of different angle historiographically. I really loved your narration of the bank runs and the kind of level of detail and character. And your presentation of the way that you want to narrate finance involves kind of this collection of voices. But a lot of what you've talked about in your framing remarks are really about framing a crisis and a kind of argument about more like macroeconomic level of the operation of markets. So I was wondering about how you see what your kind of goal is or intervention is in terms of the way of narrating crisis and the way of understanding kind of evidence and participants.
Yeah, thank you. I'm happy to talk about the writing, because it's what makes the work exciting on a day-to-day basis. My goal, maybe ambitiously, is to do both, to do the macroeconomic top-down version and to try as much as you can, given limited sources, to reconstruct the actual experience of the crisis. Because it was a crisis experience, not just by banks and bankers, but by people. So to try to, as much as you can, level out the narration of these things. The engine of, I have been maybe more finance specifically focused here, because it's a group that would maybe has given me great feedback on the finance related aspects of the study, but especially in the later chapters when I'm talking about the fallout of the crisis, that's going to be less focused on the actual banks, and will hopefully sort of spread geographically further and further from Shanghai. That's a little hard in China because you don't have that many sources, but I have a little bit of labor stuff. I have some basket weavers and others who lost their jobs and were looking for work, and other indicators from the labor perspective of what's going on. So approach-wise, top-down and bottom-up, I guess, would be the goal, to give as complete a picture as you can with limited sourcing on a subject like this.
I have an additional question, and then I'm gonna read a few points on chat. We have 3 minutes left, so it's more like food for thought for you. And my question follows closely what Mary just exposed. So on our hand, you have this wealth of analytical frameworks, even the spark that you mentioned, the technological innovation to begin the bubbles, even though it was not the spark for the crisis itself. It's a great way to organize the narrative of the crisis, but I would love to see more in your writing, and I see great glimpses of it, of ways people articulated the crisis and the aftermath of the crisis. And I think this goes a little bit to the question that Sergio was raising, right? What were the winners, not just the losers of the crisis, how this passed on into future crises, which I think was the point that Jajal, you brought in the beginning of the conversation. So how this becomes kind of a meta narrative about the narrative you're trying to explain to us. And just the points, the extra points on chat. So Jajal, you has another question about where did the Chinese capital come from to fuel the 80-83 boom? Butakli says, good point on analyzing 19th century Hong Kong and comparing it with Shanghai. Jajal Liu has another point, more from private merchants and bankers, or also from Guangdu Shangbang, and forgive my pronunciation.
Those are the self-strengthening.
Asks, are the attitudes and observations of HSBC managers available to you? So you have 1 minute. I'm sorry to bombard you with questions and comments, but it was a very generative discussion. Would you like to address anything else?
That is a lot. It's all good food for thought for particularly for the later chapters. The winner's point is interesting. The capital point is that a lot of the bankers originally got their money from trade. They were traders that had begun to found banks. So that's the simplest way to put that one. And in general, I'm just grateful to everyone for adding so much. These are voices that will be in my head as I draft, especially some of the later chapters.
Great, thank you so much, Bill. This was an excellent presentation. Thank you for all who participated in the session. We invite you for our next session on November the 15th, Business Among Friends, Personal Connections and Client Sharing in Merchant Bankers, circa 1900, a presentation by Aurelius Noble, PhD candidate at the LSE. So I hope to see you all. Thank you so much and have a good day.
Thank you.
Thank you guys so much.